Let's get back to today's session. To lead the discussion this afternoon, it is my pleasure to introduce you to Maya Brain.
Hi, good morning, good afternoon, everyone. Welcome to this FFE panel discussion on financial crime challenges in the Middle East. So my name's Maya Brain. I'm the Managing Director for the Middle East and Africa at FinTrail. And I'm joined today by an amazing panel of speakers. I'm really excited to introduce you to them all in a moment and to having this discussion. One thing I would say, the Middle East is a region that all the speakers are all passionately interested in and love talking about. So we could easily fill an hour-long discussion on numerous subtopics that we're just going to touch on today. So hopefully this relatively high-level overview is useful and illuminating to a broad range of you, whatever your degree of exposure is to the region. Because to set the scene, whether you're a Middle Eastern firm based in the region or have direct exposure because you're licensed or operate there or looking to expand there in the future, or maybe if your firm has more indirect exposure through your client base or transactions, it's clear that one way or another, a huge number of firms are exposed to this region and its financial crime threats. And especially as the fintech sector in the region itself continues to develop and to really take off, and as more international firms look to expand into the region, it's really important to consider some of the nuances and regional specific issues which come up in relation to financial crime. The Middle East is generally recognized as a high-risk region for financial crime pretty much across the board, but the specific nature of the threats and the diverse nature of all the different countries involved are more complex and not so readily understood. And perhaps more so than other regions is one that's often prone to preconceptions, misunderstandings. And so what we're going to be looking at today is sort of what local nuances firms should be aware of for effectively tackling financial crime, and what the environment's like in the region in terms of the regulatory environment and the state of maturity of financial crime compliance within the financial sector. A brief word of warning before we start. My 3-year-old son has been sent home from nursery. There's been a COVID case in his class, so I'm hoping he's happily occupied, but did just want to flag that up in case he gate crashes this session and or I have any technical challenges and have to disappear. Hopefully not, but I just wanted to give a warning on that. So to shed some light on all those questions and those topics, we have 4 wonderful speakers who it's my pleasure to introduce. So firstly, Danielle Gerges, the Regional Director of the Middle East at the Financial Services Volunteer Corps. This is a not-for-profit organization which assists emerging market countries to build strong financial systems, including a real focus on compliance and financial crime. And Danielle is currently based in Jordan, working on a capacity building project in the financial sector there, but has done work across the regions in a number of different countries. So welcome, Danielle. It's great to have you with us. And next up is Amir Hanif, the UK MLRO for Stripe, and formerly head of financial crimes for the Middle East and North Africa, excluding the UAE, and the MLRO for Bahrain, both for Standard Chartered Bank. So Amir is currently based in the UK, but formerly lived and worked in the region, and obviously has that wonderful crossover experience, having worked for a conventional bank and now for a fintech. So has some great insights on how the financial crime risks play out and how programs can be adapted for both of those institutions. Next is Patrick Lord, Commercial Director at Diligencia, which is a specialist provider of corporate intelligence and due diligence in the Middle East, Iran, and Africa. Patrick formerly worked at the risk consultancy Control Risks, where, amongst other roles covering Pakistan and India, he was managing director for the consulting business across the Middle East and based in Dubai. And finally, we have Abir Al-Fayez, MLRO at Rain, which is a Bahraini crypto trading platform licensed and regulated by the Central Bank of Bahrain. And Abir was formerly head of information exchange, so leading international and domestic cooperation at the Bahraini Financial Intelligence Unit. So welcome and thank you to all. It's great to have you all with us today. I'm really looking forward to this discussion. So the format is going to be that I'm going to ask questions and speak to everybody in turn, as obviously we're covering a broad range of different topics within this. And then there'll be time at the end for audience questions. So please send those questions through on the chat function as we go through. Don't know if you have to wait till the end. If it makes sense, we can answer them in the middle of the discussion. So please do share any questions or comments with us. So Danielle, if we start things off, I actually wanted to kick things off with a sort of general, broad opening question about what makes the Middle East a high-risk region. But actually, I wonder if we should take a step back and ask if that question even makes sense, if we can even ask that. Like, to what extent can we talk about the Middle East as a whole? Are there commonalities in terms of financial crime and compliance, or is that really simplistic? Do we need to think of it at a more granular level?
Sure. So thank you, Maya. So when we talk about the Middle East, we're talking about a very varying number of jurisdictions that have varying economic dependencies, regulatory frameworks, and political stability levels. So on the one hand, you have countries that are like Syria, that are out of the financial markets. Other countries might be dropped at a moment's notice from integration and run that risk. Such as the case with Iraq now, and they're really working on it. On the other hand, you have countries in the Gulf Cooperation Council that have significant financial resources, and their sovereign funds invest globally in the US market and UK markets. And then you also have all the countries in between. So it's important to keep that understanding in mind when talking about the Middle East. But there are also huge business opportunities in this region. Such as the case when Iran was integrated back into the market a few years ago, then taken out, but there was a real opportunity for growth there. And it's important to keep in mind when there is business opportunities, that goes hand in hand with risk usually.
Yeah, and Iran's an interesting case because that could potentially now be back on the table. Who knows? And then, next 4 years.
So when we talk about risks in the Middle East, the number one source of information usually is the national risk assessment for each country. And that is mandated by FATF, the Financial Action Task Force. But also when we think about the Middle East, we always think about terrorism and sanctions as the main risks. And that is not wrong, of course, because although these things are not very frequent, their impact is very big. When you have a few cases of terrorism or terrorism financing, things blow up and people die. So, but there are other more rampant risks that cost a lot, like, for example, tax evasion, robbery, illegal drug trade, corruption and bribery, and fraud. So, for example, from Jordan's national risk assessment, we see that the risks of tax evasion, fraud, and others have cost the country around 3.7% of GDP, and that's a lot. And for example, in Lebanon's NRA states that the number one risk is tax evasion and corruption. And as we saw in the last port explosion in Lebanon, corruption also leads to things blowing up and people dying. So like Jordan and Lebanon, other countries like Bahrain, which also published summaries of their national risk assessment, a lot of other countries have not. And we encourage them to at least publish summaries that highlight the main risks in the region, just so that the private sector is aware of those. So when we talk about financial institutions risks specifically in the region, the number one issue that always comes up is the quality of data. And when we talk about quality of data, it's basically regarding customer due diligence. So usually customer due diligence gets information on transparency, you identify beneficial ownership, bribery and corruption, you try to understand the source of funds, the source of wealth, and politically exposed persons in the Middle East. But for specifically the Middle East, there are some structural differences that make this very challenging, and everyone should be aware of those. So names, for example, in the West, you have names that are usually made of three parts: the first name, the middle name, and the last name. And these are used for KYC, for compliance checks, for understanding PEPs, politically exposed persons. And usually you have a second layer of check, which is usually the residential address or the birth date, date of birth. In the Middle East, it's a little bit more complicated than that, especially that countries vary in the number of elements they have in their name, in the names of people. So for example, in Lebanon, we have 3 part names. In Jordan, they have 4. Some countries have even up to 5. You have the first name, the middle name, the father's name, grandfather's name. Sometimes you have an alias in there. You have a nickname. You have the tribal name, and also the translation from Arabic to English lends to a lot of translation fluidity, let's say. And so, for example, let's say Mahmoud might end with M-O-U-D, and others finish it with M-O-O-D. So there's also changes there. Also, remember, we have around 150 million Muhammads in the world. So that results in a lot of false positive alerts on PEPs, on sanctions, on different checks that financial institutions do. And there was a survey by a company called Acuity that saw that around 34% of financial institutions in the Middle East have had routinely generate false positive alerts. So that's a huge number, which takes a lot of time from financial institutions. Now, this is just the name. If we talk about date of birth and residential address as secondary checks, dates of birth are also an issue because not everyone gets a birth certificate when they are born. So when they apply for a passport or other documentation, they usually have January 1st listed as their birth date. A third issue is residential address. A lot of people in the Middle East rely on PO box numbers, which is not an adequate check for compliance. You cannot use it as proof of address. So that's an added complication. And we don't rely as much on street addresses. So all these false positive alerts add a layer of cost and complexity. And then this results in a lot of delays for onboarding clients, for checking their information, all of that. So clients are also wasting a lot of time with financial institutions. In one conference, I heard a consultant say to a bank, KYC stands for know your customer, not kill your customer, with all the information they are requiring from them. So all this complex naming conventions, the lack of adequate data, the false positives, means that financial institutions really need to be very cautious about their approach to compliance. And when we also talk about risk, just an idea to finish off, it's important to stay current and up to date with the threats that are in the region. So while we think that Al-Qaeda has died with Osama bin Laden, and now ISIS is losing a lot of territory in the region, we should know that Al-Qaeda is very much alive. They just shifted their focus from big name attacks to being more involved in local politics in certain countries and local government. So being also researching that information and knowing where the influence is happening is also very important.
Yeah, agree completely. I think the more we talk about this quite a lot at FinTech, but the overlap between geopolitics and financial crime, and as a general rule, the more informed you can be about geopolitical issues, the better. And that is so true in the Middle East. And I guess for firms, it's a question of deciding what's proportionate given how exposed they are and to which specific regions. But so many conversations I've had within banks with clients, in understanding Hezbollah and how they operate and how you can start to understand if you have any exposure to them. You really need to go broader and really understand the geopolitics and how those and actually really understand what the organizations look like, how they operate, etc.
Mm-hmm.
That was all incredibly really, really useful, some really interesting takeaways for people there to consider. And I think you're completely right. I touched on the idea of misconceptions about the Middle East, but that focus on sanctions and terrorist financing because they generate the biggest headlines. And as you say, there's much more of an impact when it does go wrong. But it's not necessarily the most pervasive or everyday threat, which firms need to be aware of. It's the less glamorous tax evasion, etc., which isn't going to generate the headlines, but is possibly for many firms more of an ongoing concern. And so for your projects, you're obviously working very closely with the central bank and regulators and the government authorities. How sophisticated are they compared to others around the world, and the standards which they're seeking to implement? Do they broadly align with best practice? Because I think this is, again, in terms of perceptions, there's often an idea that the Middle East is maybe not as advanced or applying the same standards as, you know, the West, for instance. So it'd be interesting to hear your thoughts on that.
So just to put things into perspective, while Middle Eastern banks are trying to follow international standards, the bar continues to rise. So I think in 2019, Thomson Reuters reported that in each day in 2019, there were around 220 relevant regulatory changes. So that's 80,000 regulatory changes a year. So that's just to put things into perspective. Plus, the cost of compliance is a growing concern, really making financial institutions very cautious about investing in the right technology. That's because they are afraid that it might become obsolete very quickly or add a layer of complexity that might not be needed anymore. So one area where technology can help with compliance is that automation of the lengthy processes, such as false positive reviews and trade finance. And this can allow employees to focus on the more analytical and investigative tasks. Another issue of compliance in the Middle East is that these systems tend to be risk-based. So this is a challenge for both the regulators and financial institutions to try and determine what are the risks in their institutions, but not only in their institutions, across the industry and across the jurisdictions where they operate. So we all know criminals are always changing, and financial institutions need to be aware and flexible with their regulations, with their implementation, with the systems that they operate. So, but also each financial institution, of course, is mandated to have a compliance unit, a compliance department, but do they have the needed resources? Do they have a clear understanding of their obligations? And do they have support from everybody in the FI? And just to wrap up, one area where regulators can do better, as we've seen from our work in the region, is involving the private sector in identifying risk frequently, not only when there's a study, when there's an analysis, when there's FATF coming and we have to prepare the national risk assessment, but really involve the private sector as a counterpart, because they can learn from each other very much. And it is the private sector who's the first line of defense. And so we're seeing that in a lot of countries, the regulator is running to get some input from the private sector, because FATF is going to come and talk to the private sector. So we really need to make sure that we're on the same page. So this is...
and that there's more of a mechanism maybe for ongoing interaction. We were touching on this in a session yesterday at FFE-Con on dare to share and sort of interactions, you know, within the private sector and also the private and public sectors, and, you know, sharing relevant information and, you know, trying to find ways to work together more collaboratively. And one final point, which again sort of follows on from this and sort of the adherence to international best practice or not. Obviously in the last, put a number on it, but the last number of years, there has been a lot of de-risking for some of the large international banks where they have, you know, they've off-boarded a number of banks in high-risk regions and really limited their exposure, which has obviously had a huge impact in the Middle East. You know, large numbers of banks now have maybe $1 or $2 clearers, for instance, same with the euro. And so how has that affected the risk environment? Presumably that has encouraged, you know, banks in the region at least to be very aware of international best practice and what's expected by banks elsewhere.
So sure, I mean, global banks have always been, now they're increasingly becoming more risk averse to doing business with Middle Eastern institutions, especially when it comes to correspondent banking, trade finance, and money service businesses. And it is a daily fear that financial institutions live in this part of the world. It's being excluded from the financial system. And in 2019, the Arab Monetary Fund, the IMF, and the World Bank carried out a survey for 17 Arab countries, and they found that 40% of financial institutions have experienced a decline in correspondent banking relationships. So yes, the biggest fear of financial institutions is reputational risk. And to keep their reputations afloat, some financial institutions would prefer to cut ties with certain clients completely, like what we've seen with money service businesses, with nonprofit organizations a few years back, and more recently with offshore companies. And this is a very big phenomenon because there was a survey done by Revnative, which found that 72% of respondents in the Middle East, 72% in the Middle East said they would rather avoid risk than manage it. And that's a very high number. But these strategies, they are not only leading to financial exclusion, but they also, and this might be this definitely is an opportunity for fintech, but they are also having negative impact on the MENA economies. The risk here is also that the unregulated sectors are going to be driven further underground or use informal means of payment or other alternative sources of payment. But it's not only important to coordinate the sectors among each other, it has to be also cross-border. A lot of banks and financial institutions have understood this, and there are certain groups such as the MENA Financial Crimes Compliance Group, FCCG. That's a group made up of 13 banks. It's a voluntary group, and they've recognized, and it's from 9 MENA countries, they've recognized that the risks in the region are changing so much, and that AML CFT efforts have to be strengthened. And this could only be achieved by raising the reputation of the entire region. So this MENA FCCG is one resource that new companies entering the markets in the Middle East have as a resource. But this is also a resource for regulators and government to use.
That's really interesting, and interesting to see how that can be expanded or replicated elsewhere. Because I think you're right. De-risking obviously does pose a huge number of challenges, and it has both negative and, it creates potential opportunities for fintechs, but it also has that negative knock-on of banks maybe being reluctant to do what they see as high-risk business rather than working out how best to manage it, just not engaging with it because they themselves are worried of being off-boarded and de-risked by partners elsewhere. So on that note, we can turn to Amir to pick up on that point. It's obviously great to have you with us and bring your perspective from Standard Chartered and how the large banks approach the Middle East, and now perspectives at Stripes and from the fintech perspective. And so on that point about de-risking, is this something which you see at Stripe or more broadly that it can create an opportunity for fintechs, particularly in the Middle East?
Yeah, I absolutely agree that there are opportunities in the Middle East for a couple of reasons, and I'll get to those in a second. But to respond to your question, I think the key here is understanding why a financial institution de-risked either an individual, an entity, or a group of individuals and entities. And one could argue that one reason why that happened was because when in a correspondent banking relationship, a question was asked of a financial institution about their customers, they could not provide those responses. So for example, maybe they did not have as much information as would satisfy a global regulator. And one of the reasons why banks had those issues was they did not have a strong technology base setup. So for example, banks, anyone that has worked at a legacy financial institution, no pun intended with the name, a legacy financial institution will tell you that the investment in technology has really ramped up in the past few years. And I would argue that the reason why that technology spending has ramped up is that the financial institutions recognize the advantages of spending on technology to save on fines or being de-risked themselves from the financial system later in their lifespan. So if that is the reason for de-risking, then you have the counter, which is the fintechs coming in with their technology infrastructure already built, knowledge of how to onboard users with information that not only the users provide, but also that the financial services sector can collect from behavioral patterns. So for example, let's say you're a user and you open an account with a fintech. You provide 3 pieces of information. You provide your name, date of birth, your address, and then you provide your email, etc. The point that was just raised, which was very interesting and very unique to the Middle East, is the variation on the names and the variation on the date of births and the use of addresses. That is something that no financial institution will be able to resolve by itself, because that is a cultural issue. I shouldn't use the word cultural issue. It's just a cultural fact in the Middle East. So how do you mitigate that? You mitigate that by using technology on the back end, by using things like geolocation to find out where the customer is actually located and where they're logging in from. You use spending patterns. So you can see the kind of spending a customer does, where they are spending those funds, and then you can build a proper profile of a customer that is a realistic profile. If you go to a legacy financial institution and they have a customer risk rating model, that customer risk rating model will generally assign a user a risk rating and then reassess that risk rating, maybe depending on the risk rating assigned, a year, 2 years, 3 years down the road, unless there is a suspicious activity report filed on them. Now, that's not how a fintech works, right? A fintech essentially takes the information that the customer is providing on a continuous basis and reassesses that customer's risk profile on a continuous basis. And what that does is that says to the financial services sector, to the regulator, to the correspondent bank, whomever, or respondent bank, whatever they may be, and say, not only do I know what information my customer provided to me on onboarding, I know what the customer has been doing in the past 6 months. So I can tell you exactly where they're located. I can tell you what kind of businesses they do. I can tell you what cross-border transactions they do, what currency they do it in. And that really mitigates the risk, especially when it comes to a high region, high risk, high cross-border transactional region like the Middle East.
Yeah, I think that's a really good point, sort of challenging. I mean, for one thing, challenging the notion that the items you usually collect at onboarding are actually the most useful things that you could be doing. I mean, like proof of address, what does that actually tell you about a customer? And again, if you take their word for where they're based, what activities they're going to be doing, how they're going to use the account, all of that information at onboarding is the client's word for it. So it definitely makes much more sense to be able to assess that on an ongoing basis using the actual facts of how they are actually using the account and what business they're actually doing and where they're actually located.
That's absolutely right.
Yeah.
You're absolutely right. I mean, but the challenge here is obviously, so let's talk about the opportunity first, and then I'll talk about the challenges. The opportunity here is that one of the reasons why I'm a massive fan of the Middle East, and I completely understand we shouldn't say Middle East in a uniform sense, but I'm a huge fan of the Middle East, is because the unique nexus of geographic risk, which is always fascinating to financial crime professionals, and demographic opportunity, which is always of an endless interest to business. So you have that unique mix in that region. So you have a region where the under 25 population is significant and is growing. You have a region where this under 25 and under 60 population can be and is very digitally savvy. So for a fintech coming in, you have all those opportunities that are available to you to take advantage of. This is also a region, as was just mentioned, that has been heavily de-risked. So you still have businesses that need to do business. They don't know where to go. And if you are going to go not do business with a Citibank or a Standard Chartered or whomever, how you do business will be very expensive because there will be a risk premium placed on you. And that means that you will need to pay more for a transaction than you would anywhere else. That is the opportunity for fintechs. So fintechs can come in and say, I have a population that is digitally savvy, so they can adopt my processes and procedures quickly. They are under cost pressure. I can reduce those costs. So now you have an opportunity to grow business in a region. That's good for the region, obviously, but it's also good for the general economy because now you have more opportunities for the people, less unemployment, et cetera. The risk, though, is that while we've talked about a lot of good things that we can do, there needs to be an infrastructure set up to be able to action all the things we've talked about. And that infrastructure cannot be set up without the help of the government and the regulators. the thing that was just mentioned about the number of regulations that changed per day in 2019, I would posit one of the reasons for that is that the regulators and the private sector have not had bilateral conversations on the kind of controls that are being implemented to mitigate the risk. If you have a regulator that says, I need you as a financial institution, before you onboard someone, to go visit someone's location to make sure they're not a shell institution, that will slow down onboarding, right? It will essentially become kill your customer. It won't be know your customer. Financial institutions, because of their increased spending on digital and technology, fintechs can show the regulators how they can mitigate that risk without actually visiting a location, by seeing the trending patterns of a user behavior. And I am confident that if you are able to show that to the regulators, they will go, okay, you have implemented what mitigates my risk. And let me then change the regulation and not change it anymore because you have mitigated that risk. And we see that in the Middle East. I mean, we have speakers from Bahrain. So you have the FinTech Bay in Bahrain, which is a fantastic development process that they've set up. The DIFC has a FinTech hub. Qatar has a FinTech hub. All these different countries in the region have adopted this opportunity and have started to implement processes and procedures that will hopefully in the next year show us that digital banking, open banking, fintech banking, I know fintech is a pretty wide term, so I'm kind of including all these in there, provides opportunities not only for mitigating risk, but also expanding the financial footprint in a region.
Thank you. That's, really thorough overview. And I think, I'm excited just listening to you explain it like that. As you're right, the crossover between the obvious opportunities and how to mitigate the risks that come with it. And I think you're right that all of those government initiatives should hopefully provide a mechanism for fintechs to actually meaningfully engage with the regulators and explain how what they're doing addresses those risks. I think that can sometimes be the problem, that within an institution, you can be sure that you have found appropriate measures to deal with particular risks, but it's convincing banking partners, whether domestically or externally, and regulators that you have taken it on board. And we see this tick box approach across the financial crime sector, but I think you can see that sometimes from regulators and central banks as well, where they have specific things they expect to see, things which they consider high risk. And it can be difficult to have the opportunity to really engage and explain why what you're doing is different and why you're challenging the conventional ways of doing things and why that works. Right. So hopefully things like the fintech bays and the government support programs can enable fintechs to have that discussion and to say, this is why we think what we're doing is better.
Yeah, and I think the key there will be for the private sector to show that the processes they have implemented have a measurable impact in terms of mitigating risk. And for that to happen, I think we will need to do two things. One, the private sector will have to accept that in order to mitigate risk appropriately, and I'll refer to what John Cusack said yesterday in the opening remarks, we may need to reduce the pace of onboarding, because in some instances, we will need to collect more information or build new engineering infrastructure, and that will take time. So it is incumbent on us to recognize that and then implement a process that, even though in the short term may slow down the onboarding or the pace of growth, but in the long run will make sure that the bad actors are not becoming part of the financial services sector, while the good actors, and which is the majority of the clientele, is able to take advantage of the financial services sector. And then on the other hand, it is incumbent on the regulators to say, we will let the financial services firms in the door, because as was mentioned, there is a huge amount of hesitation whenever there's a FATF review to say, look, we need to implement what FATF says, and we don't care about the end result. We just need to do, like you said, Maya, the tick box exercise. And that in the long run, not only hurts the financial services sector, but it also hurts the economy of the country, because inevitably you will have fewer people who will be able to participate in the sector because the tick boxes are so onerous. And we have that opportunity to say, I know what you want to do is X. how you're getting to it is cumbersome. I can get you to X, you can test me on getting to X, but get it there this way, and it will help your citizens, your nationals, your economy, and mitigate the risk.
Yeah, agreed. Inshallah. That's all I can say to that one. So Patrick, turning to you now, and Danielle brought up one of the specific challenges of working in the Middle East at the beginning, talking about data and transparency, which I know, from a practitioner working first with a consultancy and then with major banks, is sort of diligencia's sweet spot, and really understanding what data is available and how it can best be used to inform compliance programs. Because obviously KYC is a pivotal part of any fin crime program, and so when the data isn't available or is not high quality or is highly manual, that's going to have a huge impact on various stages of the program. So at onboarding, but also investigating transaction monitoring alerts and conducting investigations when you don't necessarily have the quality of data that you do in other regions. Is that something that you think is particularly challenging in the Middle East in terms of both the quality and the availability of data and the transparency it offers?
Hi, Maya. Yeah, and without a doubt, absolutely. There's no question that because legal entity data, which is the kind of data we're most interested in at Diligencia, the kind that you can use to verify ultimate beneficial owners and so on, it's a really fragmented landscape. And by that, I mean, there's often no single source of data that you can go to for a country, let alone a region, to get that key, identifiers that you need. And probably the most extreme example is the UAE, where you can register a company at no fewer than 35 different registries within that single country. And that's something that FATF, made several references to in their report earlier this year. So you've got the 7 different emirates, of course, it's a federal structure, each with their own onshore company regulator. And then you've got the whole host of free zones, which many of the listeners will know, it's each of them are independently regulated. So which means that if you want to set up a company in the UAE and you're disposed to want to hide certain illicit activities or assets, you're going to be spoiled for choice, because ultimately these free zones are competing for your business, and some of them will make a point of saying that they won't ask too many questions and not give too much information away. So, from our side of the fence, that just makes it extremely difficult, to even sometimes identify the company exists, let alone then finding the ownership and so on. So, and I should say it's not just limited to the UAE. I think several other countries face a similar issue. Egypt, for example, where it's not so much there are different jurisdictions, but different information is held at different authorities. So you have to go to the Ministry of Trade, you have to go to GAFI, you have to go to the relevant Chamber of Commerce just to compile a sort of what we would call a comprehensive company profile. So that fragmentation is really difficult as a first point. The second one, it's an obvious one, is that often a lot of that information is simply not digitized, is not digital. Some countries do have quite well developed online company registries, and Bahrain is among them, of course, and Jordan and other countries are bringing those online. So, the picture is improving, but often, it's simply a development issue. They're just records are paper-based, and that exacerbates those issues which Danielle talked about earlier, about transliteration, about non-standardization of data, which leads, of course, to false positives and ambiguities around naming and so on. And then just the final issue is probably a sort of more of a sort of deep-rooted attitude to this kind of data in the region, where there is still a sort of feeling that company ownership is a private issue and shouldn't be necessarily in the public domain. And that will, again, like many of these things, will change over time. But all of these factors contribute to definitely a patchy level of data quality, which Danielle talked about right at the outset.
Yeah, and I think the UAE is a really interesting one. On the point of things being manually retrievable, that you would imagine the UAE and maybe other countries in the Gulf would be at a different level of development in terms of the availability of data. But when I was living and working there, that was one of the countries where you had to send someone in person down to the relevant government office to get a piece of paper. So it is across the region. It is a challenge. It's not necessarily the countries you think would be more challenging. where these things aren't available. Are things improving? I'm just sort of thinking that at one level, the governments, particularly in the GCC, are really promoting FinTech and digitization. But if on the other hand, you still have to have manual retrieval of records, how can the two possibly be reconciled? How can you have a thriving FinTech ecosystem, which kind of relies on frictionless onboarding and digital processes, if the data and the information they would need to do that isn't available? Do you think there is, are the governments changing? Are things becoming more easily accessible or better quality?
Yeah, things are changing. I sort of mentioned already, more registries are coming online and more information. There's the National Economic Register in the UAE, which is a sort of relatively recent phenomenon. But as I say, I think it's a sort of almost like a two-speed process here. At the extreme, you've got many of the Gulf countries who, quite rightly pride themselves on early adoption of digital technologies. You've got the UAE embracing blockchain, in certain sectors. You've got the first carbon neutral city in Masdar in Abu Dhabi. You even got flying cars at GITEX this week. I mean, flying cars, woohoo! But at the same time, you don't have those sort of basic building blocks of an API which feeds company data into those FinTech, hubs that we've been talking about. So that's what I mean. There's sort of two speeds here. One is really needs to catch up with the other, because until that happens, you won't get that sort of seamless customer onboarding that those digital challenger banks are aiming for, unless those, as I say, those building blocks are in place.
Is that something that you've seen in discussions with financial institutions in the region, that they would like to move away from more manual processes and are looking to, data providers or RegTech firms to try and, improve their onboarding procedures where possible? Is there appetite from the firms? Yeah,
we've been speaking to a number of banks looking to set up digital challenger banks in the region, partly probably in response to some of those issues that Amir sort of talked about, that, there has been all that de-risking going on and there is a market there. And I think, to get to that level that they're aiming for, which we see in the UK, that sort of onboarding in minutes to set up a new corporate bank account, there needs to be three things that sort of intersect really. It's a change of mindset, the technology's got to be there, and obviously the regulators need to come along for the ride and enable that to happen. Because too often when it comes to the mindset, people are still stuck in that established bank's way of doing things, where you need to have your birth certificate in triplicate signed and stamped by 7 different embassies around the world, whatever it is. We're actually, there's technology available, IDMV and so on, which makes that process but much smoother, much more seamless, but you've got to have that change in mindset. And again, that involves keeping close to the regulators, making sure they're comfortable with the sort of new way of doing things and helping to bring them along and hopefully enabling that change to happen. But there is definitely an appetite. And as I say, we're having various conversations with some sort of potential new banking market entrants in the future.
One final thing I wanted to touch on, which we haven't really discussed yet, but which is normally a key thing that always comes up for the Middle East, is the question of PEPs and political exposure. Because again, I think this is something that can be quite hard to understand from the outside. And the Middle East isn't unique in this, but it's certainly different to Western markets where you have PEPs who hold political positions which are clearly defined, and it's much easier to work out who is and is not a PEP. And it's much more amorphous in the Middle East, where it's a question of ruling families or close friendships and associations, and it's not as easy to strictly define who is and is not a PEP. And that's obviously another data input which would feed into most compliance programs. So what are your thoughts on that more broadly? Like, is it possible to have, PEP records which do give you some sort of list to screen against reliably of who is and is not a PEP? And what do financial institutions have to consider when they're using that data to make sure they're understanding it correctly?
Yeah, as a general summary, I'd say it's far less clear cut. I mean, you can obviously, one example is ruling families. We've mapped well over 10,000 members of ruling families in the region. And that's fine, but finding data on, the RCAs, the relatives, close associates, who they're married to, and so on, is far more difficult. The information just often isn't in the public domain. You've then got the issue of these big merchant families that exert influence on the economies as a whole, and that's where you get some ambiguity about the heads of some of these families who adopt semi-political positions, sometimes with ministerial status. So again, it's very difficult to make that clear judgment on whether or not they are a PEP or not. And then the other point, which is related, I suppose, to ruling families, you get this phenomenon, which isn't unique to the Middle East, of course, but around proxy ownership. There are individuals who act as owners, and on paper they are the owners of certain companies, but it's well known and well referred to that these companies are actually owned by certain high-profile figures or different interests here and there. And again, that makes the whole PEP and identifying risk ultimately much more difficult. So yeah, in essence, it's not easy, and it can be a grey area.
Yeah, and I suppose that's something firms, this is where it gets to the point you have to essentially have a tailored enhanced due diligence for those scenarios. It's really hard to build this into any kind of standardized program, but where you're dealing with any kind of Middle Eastern entity which may have political exposure, there probably isn't one source you can check or one simple step. You would need to do more open source research, conduct conversations with the company, if that's your onboarding, to try and understand the actual ownership and who actually controls the company, and take a more case-by-case basis, I would think. So from my experience, I think that's the only way it really works. It's quite hard to have any kind of standardized process to
the key is network analysis, I think, which is what we major on at Diligencia. It's not just getting the data, but how do you find the connections between them, whether that helps to build up a corporate structure or identify a UBO or identify some of those family or proxy connections. That's really the key to it, because it is all about relationships in the region.
Yeah, thank you. Moving on to Abia, I'm sorry that we are running short on time, and this is a perfect example. I mentioned at the beginning that there are like topics we'll touch on that we could easily spend, we could do a whole session on. I think crypto is definitely one of them. But maybe we could start with a sort of a general overview, particularly for those not familiar with the crypto environment in the Middle East, as to sort of what the state of play is. I mean, maybe limiting it more to the GCC to keep it more manageable. But in terms of whether crypto is, whether it's legal for a start, whether it's regulated, widely accepted, widely used, and sort of how developed the crypto environment is in the region.
So crypto is widely used and legal in the GCC. Currently, Bahrain and Abu Dhabi have regulations around crypto assets, and they both launched approximately the same time last year, and Rain was the first in the region to receive the license from CBB. Dubai and KSA are in the process of establishing regulations, as far as I know. I believe in the case of Saudi, they're taking a more cautious approach and fully understanding the landscape before they open the license.
And how informed are the regulators on crypto and the financial crime risks? Because again, this isn't unique to the Middle East, but it's something where regulators often come from a conventional banking background and see crypto and blockchain as maybe high risk in areas which they haven't worked in as much professionally themselves. How have you found the regulators in the region? Are they comfortable dealing with crypto and issuing the right regulations and guidance to the sector?
Okay, so there is a clear effort from the regulators to get more acquainted with the industry and to better regulate it, and they are taking their time to learn. And the policies are sufficient for now. However, I believe there is still room for it to develop. And as crypto becomes more common ground and develops regulations, it will have to adapt and grow with the industry. I believe there is a learning curve for the regulators that needs to go through, and they have been open about it.
Okay, which is obviously a really good first step. And we mentioned before things like the Bahrain FinTech Bay and various initiatives where the private sector and firms can actually have a dialogue with the regulators. So it's not just one-way traffic of regulations being issued and firms having to comply, but you can feed back to them. Is that something which does work in practice?
Yes, definitely. Cool. Yeah.
And one thing I was interested in, I was reading various articles which are suggesting why crypto may have real uptake in the Middle East. And it was talking about political stability and economic stability and why people may prefer to hold assets in cryptocurrency. Lebanon was one of the countries that was mentioned, obviously, with economic and political instability and inflation, that people may prefer to hold crypto rather than Lebanese lira in a conventional bank. Is that something, I don't know how diverse your client base is, but do you mostly have customers from Bahrain or the wider GCC, or do you see sort of concentrations of customers who maybe are more interested in crypto because of those geopolitical issues?
So basically, so right now we're only serving the GCC. So yeah. Okay,
something to be interesting to see in the future, I guess, because I can definitely see the argument for it. It would make a lot of sense.
Maya, sorry, just a quick comment on that. I think the advantages of crypto for the Middle East, the broader Middle East, one of them is exactly what you said. It's a holding currency essentially to store value, but it's also a good way for cross-border transactions. And as you can imagine, a country, a smaller country, Oman, for example, if they want to do business in Kuwait, the currency fluctuations can be better absorbed if they're using crypto for those kinds of transactions. But obviously that brings with it multiple risks, right? I mean, there's the standard cryptocurrency risk, which I have to, as a former MLRO in Bahrain, I'm a massive fan of the Central Bank of Bahrain. And I think they're one of the more forward-leaning regulators in the world, period. And I think if you take a look at what the stuff they're doing with crypto, it's taking global standards and implementing it in Bahrain, which is something that other regulators are also looking at. And that, I think, will help, to the point you were making earlier, that will help mitigate that risk, because you have regulators who are going into new payment methodologies using standards from FATF for their vast controls that they're implementing and then putting them in the country. And I think that's a really positive development, especially for a population that is open to using crypto.
Yeah, I think that's a really good point. And the cross-border payments question is it's a really valid one, particularly, if you look at the GCC, there is a unity there in some senses, and there has been talk about having a unified GCC currency, similar to the euro, and that you have that political bloc, and you could do something similar, and yet no imminent sign of it on the horizon. Which actually brings up another point that I was wondering. So going back to the point about regulations, like how closely do the regulations align between the different countries? If we start with the GCC in particular, and do you tend to see what happens in one country mirrored somewhere else? So if other countries are now implementing crypto regulation, for instance, do you expect that to be broadly in line with Bahrain, or is it very different between the different countries?
I can take a first stab at it. I think it will be aligned depending on what country it is. So for example, in the GCC, I would absolutely think that the Central Bank of the UAE and the Central Bank of Bahrain and perhaps SAMA, they will all have similar regulations when it comes to cryptocurrency. When you expand it and go to Egypt, Jordan, that there may be slight nuances there. Iraq will have slight nuances, but they will also be driven by the unique risk nature in those countries. I mean, the risk profile of Iraq is very different from the risk profile in Bahrain, which is very different from the risk profile in Egypt. And I think the regulations will reflect that as well.
Yeah, and presumably on a practical note, you would need to have that given the size of the market and the countries. I mean, Abir, so for Rain as a Bahraini firm, would you be looking to be regulated in other GCC countries in the future? And presumably that would only be, that would be a lot more feasible if the regulations were more closely aligned and you wouldn't have to change your compliance program too much to meet the requirements in the different markets. Just considering the size of the countries in the GCC, if you're solely operating within just Bahrain or just Kuwait, for instance, it's much more limited than if there were the possibility to have broadly similar regulations and to comply with them with a fairly standardized compliance program across the region.
Yeah, definitely. That will get things more aligned if we had like a more standard approach to it. But then again, the compliance landscape in cryptocurrency is still developing and is still working towards a deadline within FATF. So we'll see till that date. And most jurisdictions are taking like a standby approach and waiting till that happens. So we'll see till that time comes.
Yeah, that is a good point. And just tying it back around again, I guess for a final question for you, sort of in real world terms, how do you tackle some of the challenges that we brought up in terms of data availability, KYC? How do you tackle some of those challenges for your customers based in the region? Like, how does it work in practice? It's been quite doom and gloom in a way, you know, highlighting all of these problems, but obviously firms like yours do find ways to, you know, to establish KYC programs and to get comfortable with who you're doing business with.
Okay, I'll take another stab at this from a different view. You can have your KYC 100% achieved and have confidence in the KYC process and the individual you're onboarding that has good intent. However, like when you get more stricter and request more compliance documentation, we risk locking out potential customers. So it's like a fine line balance that that every regulated firm needs to manage.
True, and again, not unique to the Middle East. It's always a question of balance. And as we touched on before, there are other things you can use other than maybe the traditional data points to understand who your customer is and what they're doing, which is something that would be available, where you can look at their actual transaction data and the activities they're conducting, and you can use that to see if that meets who you think you're doing business with and whether their activities are high risk or not, rather than becoming obsessed with a very strict defined list of conventional data points. I think we're going to have to wrap it up there, which is a shame. I had various other questions I wanted to ask, and I think there are some from the audience, which maybe we can respond to you in writing briefly afterwards. But thank you all very much for participating. It was a really interesting discussion. I thoroughly enjoyed that. And I will hand back to JP to wrap things up.
Brilliant. Thank you, Maya. And thank you, Danielle, Abir, Amir, and Patrick for sharing all your practical experiences and for all your time today, and also in preparing for this session. Hopefully you found today's session valuable, and thank you for joining us, and hopefully see you at the next session or later this week. Thank you very much, and goodbye.